Ladies and gentlemen, welcome to today's edition of the Mango Monkey Show, where we talk about personal finance, investing, and building wealth. In today's episode, we will be discussing the fixed rate home loan option. We will explore the pros and cons of this type of home loan product. I am in Australia, and in Australia, there are two types of interest rates, fixed rates and variable rates. A fixed rate home loan is where the interest rate on your home loan is determined when you sign the loan contract. You will pay this same interest rate during the fixed rate period, which is usually between 1 year and 5 years, regardless of the movement in the interest rate market. As a side note, if you want to be absolutely pedantic, the fixed rate with most banks is determined when the bank transfers the money to you on the settlement day, when the loan actually starts. Some banks allow you to lock in the interest rate at the time you apply for the home loan, but you usually need to pay a fee to do this. One benefit of a fixed rate home loan is that the interest rate, therefore the repayment, will remain exactly the same during the fixed rate period. So if you choose a 2-year fixed rate, then your monthly repayment will be exactly the same for the next 2 years. Even if the Reserve Bank increases the cash rate or even if the supply of capital is tightened, your interest rate will not go up. Therefore, choosing a fixed rate is like having an insurance policy to make sure your repayment does not go up, regardless of what's happening in the market. Not only does it potentially save money, it also helps with your budget and the budgeting process. If you have a savings goal, you want to go on a holiday, or your kids want to go to a private school, then you will know exactly how much you need to save each month to reach your goal if you have a fixed rate home loan. That's good, isn't it? I mean, I have a home insurance. I want to also have a home loan insurance as well. Not always, because sometimes the market interest rate actually goes down. If your loan is on a fixed rate, you will be stuck paying the same higher interest rate, even if everybody else is getting their interest rate reduced. This is your insurance premium. You may pay a higher price than everybody else if interest rates go down. Now, one problem with this type of insurance premium is that you do not know exactly how much the premium is going to be at the time you purchase the insurance product. So you are signing blindly into your insurance purchase contract. If the market interest rate drops to 0% and your fixed rate is at 2%, then the insurance will cost 2% of your home loan balance. If your home loan is $500,000, then the insurance will cost $10,000 each year from the point at which the interest rate on the market drops to 0%. Which, by the way, is not today. It will be at some point in the future. So just because you sign your life away into a 2-year fixed rate contract does not mean that you will pay 2 times $10,000. Another benefit of a fixed rate home loan is that it can sometimes be cheaper. As of today, in October 2020, a lot of banks offer a fixed rate home loan interest rates of 2.29%. Some may even go down to 2.19%, but most of them offer 2.29% or less. On the other hand, a variable interest rate at the moment is typically between 2.5% and 2.8% for the property that you live in. Traditionally, I have heard that variable interest rates tend to work out cheaper over the long term because having a fixed rate contract is like buying an insurance policy to make sure the repayment does not go up. Insurance is never free. Somebody needs to make money. So the smart people at the bank will do whatever they can to make sure they make money. They will try to predict the future movements in interest rates and price their fixed rate offerings accordingly to ensure there is a hidden insurance premium in them. However, this does not necessarily hold true all the time. You see, the banks get your money from somewhere. It can be a wholesale investor, whether in Australia or overseas. Sometimes those wholesale investors want to buy insurance for themselves. They do not want to take a risk that the market rate may go down for them. So they offer your bank a lower interest rate. If your bank borrows money from the wholesale investor at a fixed interest rate. So effectively, the person paying for the insurance premium is the wholesale investor who provided the money to your bank. Now comes 2020. 2020 is a special year. The Australian government is offering the banks very cheap money in order to ensure the banks always have access to funding and to stimulate the economy. They offer the cheap money with a 3-year fixed rate. So a lot of banks are getting this 3-year coronavirus money from the Australian government at a very low interest rate. Naturally, the banks do not like to sit around on this money if they cannot lend it out. Because even though it is cheap, it still costs them money. So the banks now offer very cheap home loan rates if you choose either a 2-year or 3-year fixed rate. Let's talk about offset account and the extra repayments. In Australia, most fixed rate home loan products do not come with an offset account and do not allow you to make additional repayments. Some banks allow you to pay extra, but there is usually a limit, such as a $5,000 or $25,000 limit each year. So if you are a high income earner, you are a really cheap person who never spends anything, and you do not invest in the share market, your money will get stuck in a savings account. So instead of earning a 2% tax-free return against your home loan account, it will earn a 1% or 1.5% return only, which will also get taxed. So the end result is that you will get less than inflation in the current environment. However, there are a handful of banks who offer an offset account even on their fixed rate products. I know a couple who offer 100% offset facility. So every $1 in your offset account will reduce the effective home loan balance by the same $1. I also know one bank who offers a 40% offset facility, which is where every $1 in your offset account will only reduce your effective home loan balance by 40 cents. This bank still allows you to put $1 into your home loan account itself, so you can still get a dollar for dollar benefit, less any potential break costs. But if you want to put it in the separate offset account, it only reduces your home loan by 40 cents. Let's talk about break cost. What is a break cost? Break cost is a fee that your bank will charge if they have effectively lose out because you make too much additional repayments into your fixed rate home loan, or if you paid the loan off completely. That is, when you either refinance to another lender or when you sell your property. How much do you need to pay? You can never know exactly. It's worked out by some complex formula. Each bank does this slightly differently. Some will tell you the formula, others do not. It gets too hard and messy to try to work it out. But the basic idea is that the bank will compare the interest rate at the time you took up your fixed rate home loan to the current interest rate at the time you make the additional repayments or pay off your home loan in full, and charge you for the difference if the current interest rate has dropped. So the bank will compare the interest rate in the past and the interest rate today. But what kind of interest rates do the banks compare? Well, this is where the mystery kicks in, because some banks use some kind of reference rate that is available on the public domain, such as the bank bill swap rate, but some other banks use their own actual cost of funding, which you can never find out. Neither of these rates are the same as the Reserve Bank cash rate, or the interest rate which the bank advertises on their website for new customers. So long story short, break cost can be zero, that is nothing, or can be very large depending on how far interest rate has come down since you took out your home loan. Break cost is only charged pro rata. So if you are 1.5 years into a 2-year fixed rate contract, you pay the equivalent of 6 months of the difference in interest rates. Wait a second, can we go back to the offset account bit? Of course. Offset account is a bank account, savings account, like any other savings account. So when you log in into your internet banking, you will see two different accounts. One is the home loan account, the other one is the offset account. But on the back-end system at the bank, they have a third account, which is a hypothetical loan account. The balance of this hypothetical loan account is essentially the balance of your home loan account reduced by the balance of your offset account, calculated every day of the week. So if you put money into the offset account, it will reduce the balance of your hypothetical home loan account. And if it is a 100% offset account, each dollar you put into the offset account will reduce the balance of the hypothetical home loan account by also $1. This means you will end up paying less interest. Instead of putting your $1 into your offset account, it is also possible for you to put the money into the home loan account itself. If you do that, you also will pay less interest. So it works out to be pretty much the same, as long as your bank offers you what's called a redraw facility, which will enable you to take the money out again in the future. A redraw facility is a facility or feature which allows you to take whatever extra money you've put into your home loan account back to your own bank account, your own savings account. If you do want to be a little bit pedantic, there are some differences between an offset account and a redraw facility. Difference number one, if you pay $1 into a redraw facility, your home loan balance itself becomes $1 smaller. So if your bank goes bankrupt, you owe the bank $1 less, but you will not be able to take out your $1 because you owe them a debt. The bank does not owe you anything. On the other hand, if your $1 is put into your offset account, you owe the bank the full home loan balance, but the bank owes you $1. So it is more likely that you will be able to get your $1 back without having to wait for the property to be sold. And with this $1, you are able to use it to buy a couple of soft-serve ice creams at McDonald's. A lot of home loan contracts also allow the bank to turn off the redraw facility, even if the bank has not been bankrupt yet. So if the bank is about to go bankrupt, or they think you are about to go bankrupt yourself, and you don't deserve the extra $1 back because you still owe the bank more money, the bank may be able to switch off your redraw facility and you will lose access to your $1 money. Difference number two. The second difference is the tax treatment of your loan and offset account. Although I am not a tax agent and I cannot give you any tax advice, you should talk to your accountant to check if there are any differences in the tax treatment of an offset account versus a redraw facility. It is likely that if your home loan is for an investment property or for a property who may become an investment property at some point in the future, because you never know what will happen in the future, right? There are tax advantages to putting your $1 into an offset account instead of a redraw facility. This may be the case if at some point in the future you take out the $1 again. If you never ever take it out again, generally speaking, there are no tax advantages. Did you know that you can have both a fixed rate home loan and a variable rate home loan at the same time for the same property? If your total debt is $500,000 and you believe that in the next 1 or 2 years you will have around $100,000 saved up, you are able to have $100,000 as a variable rate home loan and a $400,000 as a fixed rate home loan. This setup will enable you to pay down the loan by $100,000 even if the bank does not offer an offset account for their fixed rate loan product. It's like buying a half and half pizza if you're not sure what to get. If you are still here and want to help me out, please hit the like and subscribe button so that I can grow my channel. My name is Mango Monkey and I make a lot of personal finance videos for you guys for free. I love the mango fruit, so I'm curious to see what fruits you guys love. Let me know in the comment section down below. I'll see you next time.